So you're in the process of getting life cover, but how much do you need? That's what we're talking about in this video. Hi, my name is Yolanda. I'm a wealth advisor, and it is my goal on this platform to give you easy, actionable tips, content, and strategies that you can use to manage money well, to live abundantly, and build generational wealth. So how do you understand how much of life cover you need? Well, the first thing you got to do is you got to understand how much debt you have. So list that down, your bond, your car, maybe you owe somebody money. Okay, usually with bank products there's credit life attached to it, so I wouldn't worry too much about bank products and those loans from financial services companies. The next thing I would do is try to understand who is depending on me. Who do I support every month from my salary? If you're a younger person that's listening to this and you're not supporting family members and stuff like that, there might not be a need for life cover at this point. But if you're busy planning your life, you've got a 5-year plan, 10-year plan, you've got a spouse and kids down the line, there's value in you taking bare minimum life cover now, which is 100,000 Rand, and with the capability of future protecting that cover, where when you need that cover in the future, you can just unlock it now instead of being stuck with high premiums at this stage in your life. All right. But obviously, if you're somebody who's a little bit more mature, you have a lot more dependents, kids, family members, parents that you are looking after. Obviously, now you have a little bit more on your plate that you got to prepare for. So how I see it is, when it comes to your parents, you got to leave them a little something, understand how much you're giving them every month, and try and project 10, 15, 20 years in the future, how much would they need? I do the same for the kids. With under 18 kids specifically, I would plan bare minimum. I would plan until the child's 24th birthday to ensure that they get an income. So this planning is only if you have dependents and you're just making sure they have everything they need in order to live life accordingly, as if you were here providing for them, right? It's not for wealth building and generational wealth building or anything like that. That's a separate conversation altogether. Then I would list the assets. The key thing that we need to understand is what happens to the various assets when we do pass away, from your house, your retirement, your shares that you're holding, unit trust, tax-free investments. You got to know what happens to all of that. You do a calculation, speak to your advisor. He would give you your estate liability calculation. Then you would know how much of life cover you would need. So when it comes to life cover and addressing these needs of your debt and your estate planning, I would recommend lump sum life cover. Why? Because you don't want your family that you leave behind and your dependents to be worrying about these large amounts of debt. So upon your passing, you just want the debt settled, all right? And you want to have enough to wind up your estate. However, when it comes to addressing the needs of your dependents, there's a lot more savvier way that you can do it, and a more cost-effective way that you can do it, rather than leaving your dependents large lump sums of money. Now, this is a consideration that you should take to ensure that your dependents have what they need in order to live an uncompromised lifestyle now that you are not around, right? It's not to address the need of generational wealth planning. So to address the needs of your dependents, my recommendation is to leave them life income cover. Life income will ensure that your insurance amount is paid out in monthly incomes for a set period of time. Ideally, when I plan for my clients, the bare minimum I try to leave for the dependents is I look at the age of the youngest child, all right? And I will plan from that point in time when I'm planning up to the child's 24th birthday, the bare minimum. Obviously, if there's a greater need in the family or affordability is a little bit more, we can plan for a longer period. But the bare minimum I plan for is from the age of the youngest child to until that child reaches minimum age 24, to ensure that there's constant income coming into the house. By doing this, one, I'm able to bring down the premium of that insurance product. All right, because I'm not leaving a life lump sum. The insurance company doesn't have to pay huge amounts of lump sum that could easily be squandered in the hands of somebody that does not know how to handle large sums of money. It will give you peace of mind knowing that, despite what happens, there's always going to be an income for a set period of time for my kids and for my dependents. Also, it can be tax effective as well, because remember that when a life insurance pays out, you don't pay taxes on that. But if you don't leave life cover to your spouse, there is a state duty charge. All right, that portion is going to be charged estate duty taxes when you leave life cover to anybody else other than your spouse. But the proceeds from that, there's no income tax that you got to pay on those proceeds. So those life income payouts happen tax-free every month from 5 years, 25 years, 30 years, or even the whole of life of the dependent. And why it's better to leave life income as opposed to lump sum also is the tax benefit. Also the tax benefit of, if you leave a 5 million, 10 million lump sum to the family, it can be squandered if not used appropriately. Also, if you take, nobody's going to live off 10 million at one go. So you're probably going to keep, the family is probably going to keep a portion for living expenses for a year or two and then invest the rest. And when you invest into investment products, you're going to be taxed depending on the nature of the investment. Then the family is going to live on income from after-tax money, which could be a lot less than the need of the household at that time. So life income is nice because you can structure the life cover to increase with inflation every year. For example, if your family lives off 20, you can leave your family 20,000, and every year the 20,000 will increase according to the rate of inflation, or a fixed rate of maybe 5 or 10%. The control is in your hands as the product buyer. Life income is a modern way of doing life insurance planning. It's a modern way of planning for your family, and it gives you peace of mind as well. Remember, this recommendation of life income is only for the need of meeting the need of your dependents now, and not generational wealth. And the major point of that is that life income is always cheaper than life lump sum cover. Right? If you want to explore the option of life income cover in your financial plan, feel free to reach out and I'll be happy to help you. Also know that the content of this video is not financial advice. I'm a fit and proper South African financial advisor. I am the founder of this platform, Financially Fabulous Females. I am also the director of Solomon Wealth. So as a fit and proper financial advisor, these videos and all my other social media content is financial education. It's there to give you thinking points and to teach you about what you can expect from financial services in South Africa. Do not act on this as financial advice. I'd love to chat with you one-on-one if you need financial advice. So click the link where you're watching this video and we can chat. And for more on financial services and life insurance in South Africa, check out this video.